Support and resistance are two key ideas that help traders understand how price moves. They show where buying and selling pressure often appears and where the market is likely to pause or change direction. These levels are based on how traders behave and how they react to price changes. Support is a price level where a falling market often stops and starts rising again. This happens because buyers become more active at that level. Many traders see support as a floor under the price. When price drops near a known support area, buyers may step in and short sellers may cover their positions. This creates upward pressure on price and helps keep it from falling further. Support usually forms at previous lows on the chart. Resistance is the opposite. It is a level where a rising market often stops and turns lower because sellers become more active. Traders see resistance as a ceiling over the price. When price gets close to a known resistance area, traders who bought earlier may take profits, and new sellers may enter. This pushes the price down. Resistance usually forms at previous highs. A very important feature of these levels is that support can turn into resistance, and resistance can turn into support once they are broken. If price moves above a resistance level, traders may now see that same level as a place to buy. If price drops below a support level, traders may now see that level as a place to sell. This switch happens because traders adjust their positions and expectations when price returns to these levels. The psychology behind these levels is simple. When price rises above old resistance, traders who sold earlier may regret getting out too soon. They may want to buy again if the price comes back to that level. Their buying turns old resistance into new support. When price breaks below old support, traders who bought at that level now hold losing positions. If price rises again toward that level, they may want to sell to break even. Their selling turns old support into new resistance. These common reactions helps in explaining why price often changes direction near familiar support or resistance zones. Some support and resistance levels are stronger than others. Levels become more important when price spends a lot of time trading near them, because many traders enter or exit positions there. High trading volume around a level also increases its strength. Recent levels tend to be more powerful than older ones, because traders remember them more clearly. Another point to remember is that markets often respond to round numbers, like 50, 100, or major index milestones. Many traders naturally use these numbers for entries and exits, so round numbers often act like support or resistance areas even when charts do not show strong history there. Support and resistance give traders a simple and reliable way to understand market structure. By watching how price behaves around these levels, traders can plan entries, exits, and stop placements more effectively. These concepts are the building blocks for many other technical tools and help bring clarity to price action that may otherwise look random.